Hi, I wanted to walk through some exam 3 practice problems. So the first couple are from chapter 21. Based on predicted production of 12,000 units, a company anticipates 150,000 of fixed costs and 123,000 of variable costs. The flexible budget amounts of fixed and variable costs for 10,000 units are. So we're asked to do a flexible budget. So there we're going to be looking at fixed and calculating that versus in addition, the variable costs. So as we know, fixed costs are not going to change with different levels of production, but the variable costs are. So the first thing to do is to split your costs. For this example, it's already split for us. And it gives us variable cost of 123,000 that applies to 12,000 units. So we need to get the variable cost per unit. So to do that, we're going to take the variable cost divided by the number of units, and we're going to get $10.25 each. We're going to multiply that times 10,000 units, so the variable cost is 102,500. Fixed costs are going to remain at 150,000, and if you wanted to add them up, we'd get 252,500 in total for the flexible budget. The second problem is calculating our price variances. So there's a couple different formulas that are shown in the book. I tend to always lay it out like this and in a table format. You're less likely to make an error because you just need to make sure that you pick up the right numbers. So we're given calculate the direct price, materials price, quantity, and total variances. It gives us direct materials at standard, which is 100,000 units at $2 each. And it gives us actual, 105,000 at $180. So to set up the table, we're going to have actual quantity times actual price. And we're going to compare that to the actual quantity and the standard price. So you see, when we're calculating the price variance, we're keeping the quantity constant. It's not changing. We're just looking at the effect of the different prices. So if you take 105,000 times $1.80, you're going to get 189,000. If you take the actual quantity of 105,000 times $2, you're going to get 210. If you take the difference between these two, is $21,000 price variance. And you have to be able to determine if it's favorable or unfavorable. So basically, favorable is going to be less cost. So since our actual is less than the standard, then this variance is going to be 21,000 favorable. To calculate the quantity variance, we're going to have actual quantity times standard price, and we're going to compare that to the standard quantity times the standard price. So in this calculation, you'll see the price is remaining constant, but we're looking at the effect of using the different quantities. And in this fact, you can look at the actual quantity of 105,000 and standard is 100,000. We can tell that the variance is going to be unfavorable. It took us more materials, more quantity than we thought it would, than the standard. So if we multiply these two out, we get 210,000 and 200,000. So we get a variance of $10,000, and again, it's unfavorable because the actual quantity is more than the standard quantity. Then to calculate the total materials variance, you can add these together. If one's favorable and one's unfavorable, you're going to take the difference. If you think about if you're adding a positive number and a negative number, you're going to take the difference, and the one that's the larger is the one that's going to be the answer. So for this case, 21,000 minus 10,000 gives us 11,000, and the favorable is larger, so it's going to be 11,000 favorable total variance. You can also take the difference between the 189,000 and the 200,000 and get the same answer. On number 3, very similar, but we're looking at the rate variances, the labor variances. So we're going to calculate the direct labor rate, efficiency, and total variance. So we're given actual direct labor hours used, actual direct labor rate per hour, standard direct labor rate per hour, and standard number of hours that are used, 67,000. So again, we set up our table. So the first calculation, actual hours times actual rate, and we're going to compare that to actual hours times standard rate. Again, the number of hours is remaining constant. We're looking at the effect of the different rates. The actual rate is higher than the standard. So this is telling us it's going to cost us more than we thought. So by that information, we can determine that it's going to be an unfavorable variance. And then we're going to subtract the 975,000 minus the 910,000, gives us 65,000, again, unfavorable rate variance. To calculate the efficiency variance, we have actual hours times standard rate, and we have standard hours times standard rate. So again, the rate is staying the same. We're looking at the effect of the different hours. Actual 65,000, standard 67,000. So actual is less. So that means it costs us less than what we thought. So the variance is going to be favorable. So when we subtract 910,000 and 938,000, we get 28,000 favorable efficiency variance. And then for the total, again, we're going to combine them. So we have an unfavorable and a favorable. So we're going to actually subtract them as the math that you're going to do to get 37,000. And since the unfavorable is larger, we're going to have 37,000 unfavorable total variance. The next question, LAC Company is considering replacing a machine. So remember, when we're looking at these problems, we're going to be looking at what is relevant between the alternatives. So the new machine would cost 100,000 and the old one can be traded in for 20,000. So here we have the cost of the new machine. That's going to be cash going out. However, we are going to get a reduction because we're trading in the old machine. So that's going to be a positive. The new machine will reduce variable costs by 10,000 per year. And the 10,000 per year is going to be over 5-year life. So we have $10,000 variable costs that we're going to have a savings times the 5 years. So variable costs in total will be reduced by 50,000. So that's going to be a positive to our bottom line. We're asked to calculate the total increase or decrease in net income by replacing the current machine with the new machine. So if we look at the cash going out for the new, but we also have the trade-in, so that would be a positive. We have a savings in variable costs. So it ends up being an overall $30,000 decrease. We have more going out for the cost of the new machine than we are saving in variable costs and the cash coming in for the old machine. The next problem, Red Company has received a special one-time order for 15,000 Red cases at $270 per unit. Red currently produces and sells 75,000 units at $670 each. This level represents 80% of its capacity. That information is given to us just saying that we can take on additional business without affecting our capacity, without affecting our current production, and we're not going to incur additional fixed costs. These cases will be marketed under the wholesaler's name and would not affect Red's sales through its normal channels. Production costs for these units are $365 per unit, which includes $210 variable costs and $1.55 fixed costs. So by their cost behavior, we know we're going to incur additional variable costs. So we're going to take the 210 times the number of units. However, fixed costs are not going to fluctuate with different levels of production. So we are not going to incur additional fixed costs. If Red accepts this additional business, the effect would be, so if the question asks the effect on revenue, you're going to be looking at the number of units to be sold times what you are selling them for this example, 270. So the effect on revenue is 40,500. Or it might ask you the question, what is the effect on costs? So again, you would take the number of units being sold times the cost. It's going to be just the variable cost. So that would be 31,500. Or the question could ask the effect on net income. So you can take the difference between these numbers and get 9,000. Or if you looked at and determined that on a unit per unit basis, they're sold for $2.70, they cost $2.10, therefore the increase is 60 cents per unit. And you could take this 60 cents times the volume of 15,000 to determine 9,000. Same answer, just different ways to get to it. On Chapter 24, a machine costs $400,000 and is expected to yield an after-tax net income of $9,000 per year. The machine has an $80,000 salvage value. Compute the accounting rate of return. The formula, annual income divided by average investment. So we have our annual income of $9,000. We calculate the average investment by the book value at the beginning of its life and the book value at the end of its life. So the beginning is going to be the cost, and the end of its life is going to be any salvage value. So we would take the $400,000 plus $80,000, and we're going to divide by 2 to calculate the average investment. Then to calculate the accounting rate of return, we're going to take the annual income, $9,000, divided by $240,000, gives us 3.75%. And the last question, Starbucks company is analyzing 2 products or projects for the future. Assume that only one project can be selected. So that this company uses the payback period method for its determination, and it requires a payback of 3 years or less. So it's asking us which project would be selected. So we have project A and B, and we have the cost of the machines, and then we have the net cash flow. So we're going to take the cost divided by the annual net cash flow. So for A, it's going to be 2.75 years, so it definitely meets the less than 3-year criteria. And then for B, we're going to take the cost of $55,000. We're going to take the average, so we're going to add 2 plus 25 plus 25, since it has to be within 3 years. And we're going to get 3.17 years. You could also look at this and determine that $52,000 at the end of 3 years, which is the criteria set by the company, does not cover the cost of the machine. So the project A would be selected.